Hello, my name is Alice and I am a Canadian Chartered Professional Accountant. In the earlier years of my career, I was professionally trained in Canadian tax. And in today's video, I want to talk about the Canadian tax changes that you should be aware of for 2025. We're talking tax brackets, tax credits, registered accounts, and deadlines to be aware of. Do me a favor and hit the like and subscribe button and let's get right into it. As a friendly reminder, here are all of the key deadlines for 2025. So if you're a business owner paying yourself a salary or a dividend for 2024, you have to file the tax slip with the CRA by February 28th. February 28th is also the RRSP deadline in Canada. Personal taxes, as always, are due on April 30th. If you are a sole proprietor, your tax return is due on June 15th. And for corporate taxes, if you have a December 31st year end, the deadline to file is on June 30th. For late filing, if you file late, you owe 5% of your 2024 balance plus 1% of each month that the return is not filed up to 12 months. For late payments, there is a daily compounding on the balance owing, which starts accruing on May 1st. Now, if you're self-employed, you have additional investment or rental income on top of your job, you have more than one job, or for whatever reason your employer isn't withholding enough tax and you owe more than $3,000 of tax in a year, you may also be subject to installment payments. So installment payments are due on March 15, June 15, September 15, and December 15. These are the deadlines. Let's start with income tax brackets. Every year, the CRA adjusts the personal tax brackets based on inflation. This year, the inflation rate as reported through the CPI is 2.7%. In 2024, CPI was 4.7% and it was 6.3% in 2023, which actually signals that inflation is going down. But here on the screen are the federal brackets for 2025. Let me quickly reiterate what this actually means. The Canadian taxation system is based on marginal tax rates. So let's say you make $150,000 at your job. You would not be paying tax at 26%. A part of your income gets taxed at 15%. A part of it gets taxed at 20%, and a part of it gets taxed at 26%. This is the definition of a progressive tax system. So what you owe to the government every year includes provincial tax, federal tax, as well as your portion of CPP and EI. So tax credits. First, let's talk about what tax credits actually are. There is a difference between tax deductions and tax credits. Tax deductions, like medical expenses or childcare expenses, they reduce your taxable income. And from taxable income, we calculate your taxes payable. Taxes payable is how much you actually owe the government in a given year, and that's calculated based on your annual taxable income. And then we have tax credits. These tax credits are given to us by the government to help us reduce what we owe. Now, there is a pretty long list of federal and provincial refundable and non-refundable credits that have different qualifying criteria. But how this works is that they basically all get added up together, multiplied by 15%, and that amount is what reduces your taxes owing. So the ones that are changing this year includes the basic personal amount, which is basically how much money a person can earn without paying income tax. So this has gone from $15,705 in 2024 to $16,129. And what this means when it's applied to you is $16,129 times 15%, or $2,419 of tax savings. So the actual tax effect between 2024 and 2025 is $64. Now, BPA does start getting clawed back for any income that's above $177,882, which is the 29% bracket. But basically above this level, your BPA starts to go down. And once your income hits $253,414, your tax savings actually goes down to $2,180 compared to what I mentioned previously. The age amount is a tax credit that's available to anyone over the age of 65 or older as of December 31st of the taxation year. And the maximum amount that can be claimed in 2025 is $9,028, which is up from $8,790 in 2024. The after-tax effect of this difference at 15% is $35. OAS recovery threshold. So if you qualify for OAS, but you are high income, you're actually required to repay that OAS back to the government. Now in 2025, if your net income exceeds $93,454, you have to start repaying OAS. So this is higher than it was in 2024, which was $90,997. And basically that OAS gets clawed back fully until your income hits about $150,000. So once you are around the $150,000 for income, you will have to repay back all of your OAS. Now, what about deductions? So for medical expenses, you're allowed to claim any eligible medical expenses on your personal tax return, but you can only claim expenses after they exceed a certain amount, which is either 3% of your net income or the prescribed amount. And the prescribed amount in 2025 is $2,834, and in 2024, that was $2,759. So using that 3% calculation, if your income is over 2,834 divided by 0.03, which is 94466, you can claim any medical expense amount over 2,834. CRA does have a pretty comprehensive list of what is considered an eligible medical expense, and that's something that you can look up online if you're wondering whether an expense that you paid is eligible or not. Okay, what about RRSPs? So in Canada, all contributions that you make to your RRSP and your spouse's RRSP are tax deductible. The maximum contribution for 2025 is $32,490 compared to 2024, which was $31,560. And we also know the 2026 limit now, which is $33,810, which is good for future planning and endeavors. Now, this is the maximum contribution amount. It's not necessarily the contribution amount that you might be entitled to, because your RRSP annual contribution limit is calculated based on a couple of things. It is actually based on the lesser of 18% of your earned income in the previous year, as well as the annual limit of $33,810. If you earn benefits under your employer's RPP plan, this may also impact your contribution limit calculation as well. So 33,810 divided by 0.18 is 187,833. So that amount is the income that you need in order to be eligible for the maximum contribution amount. If you don't know what your contribution limit is, no worries. The CRA actually automatically calculates this for you. It's available if you log onto My CRA, and it's also available on your notice of assessment as well. I get many questions from people all the time asking me, how do I reduce my taxes owing? And the first question that I always ask is, have you maxed out your RRSPs? Because that's the first place to go. Now, the RRSP deadline for Canadians is March 1st, 2025, meaning that all contributions made before March 1st can be applied against your taxable income to reduce your taxes owing for 2024. Now, what about TFSA? So in 2025, the annual contribution limit is $7,000, and that brings the total lifetime contribution limit to $102,000. For someone who has never contributed and has been eligible for TFSA since the introduction in 2009. So if you were over the age of 18 in the year 2009 and you had a SIN number, then your lifetime TFSA contribution this year is going to be $102,000. If not, that's okay. You're still entitled to all of the annual limits on this table up on the screen to the extent that you are TFSA eligible in a given year. FHSA, this is a relatively new account that's been introduced in the past few years to help Canadians with the purchase of their first home. So in the first year that you have the account, you can contribute up to $8,000. If you don't hit the limit in any year, that unused amount carries over, which can lead to higher limits in subsequent years. But everyone faces a lifetime contribution limit of $40,000. And like an RRSP, contributions are tax deductible. So right now it's mid-December, and one thing that you can actually do before the end of the year is to open up an FHSA account if you haven't already. Now, you don't need to contribute any money to it, but the fact that you opened it before December 31st allows you to have that $8,000 contribution route. So CPP is a monthly taxable benefit that replaces a part of your income when you retire. And the maximum pensionable earning amount is $71,300 in 2025, which is up from $68,500 in 2024. The basic exemption amount is still $3,500, and your contribution rate is still the same. So you still have to contribute 5.9% of your pay. If you are a business owner that withdraws a salary from your company, you will have to pay 5.95% times 2, which is 11.9%. Now, there is a new thing called CPP2, which is like a second tranche of contributions. So any earnings between $71,300 and $81,200 are actually subject to a new tranche of CPP contribution. And it's basically this additional amount that's required to be paid. Now, what does this actually mean? If you are a high income employee, it means that with these new limits, it can take you a little bit longer to max out CPP during the calendar year. Once your year-to-date income hits $81,200, you will have maxed CPP out for the calendar year, and usually your paycheck goes up by a couple $100 when this happens. For EI benefits, so if you are on maternity leave or you are claiming EI benefits, the benefit rate maximum weekly is now $695 a week, which has increased from $668. And for extended parental leave, it has gone up from $401 to $417. The EI premium rate has actually gone down from 1.66% to 1.64%. This is the employee portion. So what this means is that 1.66% of your gross income is withheld from your paycheck up to a maximum of $65,700. And the maximum annual premium amount, which is the most that you can pay into EI has gone up from $1,049 in 2024 to $1,077.48 in 2025. So once you've hit $65,700 in year-to-date income, you will have maxed out EI. This also means that you usually will max out EI before maxing out CPP in a given year. Now, if you are a self-employed business owner and you pay yourself a salary, you can elect to be EI exempt, meaning that this doesn't apply to you. But for an employee, just note that your employer is still required to contribute their portion, which is 1.4 times. Prescribed rate. For the first quarter of 2025, the prescribed interest rate will be 4%, which applies to all taxable benefits for employees and shareholders, interest-free loans, and related party transactions. Now, there are a few different use cases for this prescribed rate, and the rules around this do start to get a little complex and specific to the individual. So for example, if you loan funds to your spouse at the CRA's prescribed rate of 4%, your spouse uses that to invest. Your spouse then has to pay you annual interest by January 30th of the next year. This can also apply to business owners that withdraw funds out of their company, which may be classified as a deemed benefit if it's not paid within 1 year after the end of the tax year. Basically, that just prevents people from pulling money out of their corps on a tax-free basis and never repaying back. Interest is technically applied if the loan meets the criteria of a deemed benefit. So a couple of different use cases for when the prescribed rate actually applies, but those two are just examples. Lifetime capital gains exemption. Now, the LCGE has seen a significant bump to $1.25 million in 2025. Now, the LGCE is a huge tax relief that's available to Canadians, which hold certain types of eligible assets. The most common is small business corporation shares, also farming and fishing property. Whether you are eligible for LGCE actually requires you to speak to an accountant because there is judgment involved in identifying whether the asset that you own qualifies. The capital gains inclusion rate. So in June 2024, the Canadian government made a big announcement, and that is that they would be making changes to the capital gains inclusion rate for both personal, corporate, and trust tax, which is actually a huge, huge deal. Now, many people have many opinions about this, and there's also politics involved. But the latest update is that this change is still in question and it's not law yet. It is up for a confidence vote, which means that there does need to be a majority vote for this change to become law, as well as the current government to continue in power. So if you own stocks in a taxable account or an investment property that's not a principal residence and you've made more than $250K on either of those things, the government is basically proposing that 2/3 of that is going to be included in your taxable income rather than half. And this applies to corps as well. So any assets owned under a corp that are disposed at a gain, 2/3 of that will be included in your income rather than half, and same for trust. One thing worth mentioning is that they have proposed this thing called Canadian Entrepreneurs Incentive that's been released by the government that would basically reduce the inclusion rate down to 1/3, and basically combined with the LCG exemption, entrepreneurs can have up to $3.25 million when selling all or part of their business once the incentive is fully rolled out. But it does not apply to all sectors. So finance, real estate, and professional services are not included. And you do need to own shares of a qualifying small business corporation, and not all small businesses are considered qualifying. And so just to summarize everything I've talked about around capital gains, the new inclusion rate and the CEI are basically still subject to legislation process in Canada. Okay, if you have kids, this part is for you. So the Canada Child Benefit. In 2025, the maximum CCB benefit is $7,997 per child under 6 and up to $6,748 per child between 6 and 17. Now in 2024, those amounts previously were $7,787 for a child under 6 and $6,570 per child between 6 and 17. CCB in Canada is calculated based on the number of children you have, the age of your children, as well as your family's adjusted net income. And you're entitled to the maximum benefit if your income is under $36,502. It's basically clawed back and gradually decreases based on your income. And this CCB, it's a tax-free monthly benefit. It's made eligible to families to help with the cost of raising children. Now, between December 14, 2024 to February 15, 2025, Canadians do not need to pay 5% on certain items to help with holiday relief. For a Canadian business owner, what this means is that you will need to adjust your systems to handle this GST-free window of transactions. So that's something to keep in mind operationally. If you found this video helpful today, please consider hitting the thumbs up and subscribing to the channel. Let me know down in the comments below whether you have any questions about tax, and I will see you guys in the next video. Until next time.